There's this quiet moment that happens to a lot of people, usually late at night. You're scrolling through your phone, and you see someone talking about the stock market. Maybe it's a short clip. Maybe it's a screenshot of a portfolio. Maybe it's someone casually saying they made more money this month than they used to make in a year. And suddenly, something uncomfortable creeps in. You start thinking, am I behind? Because it feels like everyone else has figured something out that you haven't. Everyone seems to be investing. Everyone seems confident. Everyone seems to know what they're doing, and you're just unsure. You've heard about index funds. You've heard about crashes. You've heard about people losing everything. You've heard about people retiring early, but no one really talks about this feeling. This strange mix of curiosity and anxiety. You want to start, but something inside you hesitates, and the uncomfortable truth is, that hesitation might actually be wisdom, because the reality is, most people are not ready for the market when they think they are, and the surprising part, that's completely normal. Most people believe investing is about knowledge. They think once they understand the basics, once they learn the terms, once they watch enough videos, they'll be ready. But readiness for the market is rarely about information. It's about emotional stability, because the market is not just a financial system, it's a psychological environment, and it quietly tests parts of your personality you didn't even realize were connected to money: patience, self-doubt, control, fear, tolerance, comparison, regret. You can understand compound interest perfectly and still panic the first time your investments drop 15%. You can know that markets historically recover and still feel a knot in your stomach when your balance decreases. You can intellectually accept volatility, but emotionally feel like something has gone wrong. Most people don't talk about this part. They talk about returns. They talk about timing. They talk about strategies. But very few people talk about the emotional weight of uncertainty, because investing forces you to live with unanswered questions, and most of us are not taught how to be comfortable with uncertainty, especially when money is involved. Let me explain what I mean. Imagine you finally decide to invest your savings, not a huge amount, just something meaningful enough that you care about it. Maybe it represents months of discipline, saying no to small luxuries, choosing long-term security over short-term comfort. You invest, and for the first few weeks, nothing really happens. Then one day, the market drops, maybe 3%, maybe 7%, maybe more. Logically, this shouldn't be a big deal. Markets fluctuate all the time. But emotionally, it feels different when it's your money. Because money isn't just numbers. Money represents time. Time spent working, time spent worrying, time spent trying to build stability. So when the market drops, it can feel like your effort is disappearing. And this is where psychology quietly enters the room. Your brain starts asking uncomfortable questions. Did I start at the wrong time? What if this keeps falling? What if I should wait until things feel safer? What if everyone else knows something I don't? And suddenly, investing feels less like a strategy and more like a test of confidence. Here's something rarely mentioned. The market does not reward intelligence as consistently as it rewards emotional discipline, because investing requires doing something very unnatural. It requires staying calm when uncertainty increases, and human beings are not naturally wired for that. We are wired for survival. Our brains evolved to detect danger and respond quickly. If something appears risky, our instinct is to step back, which makes sense in most areas of life. But in investing, reacting emotionally often creates the exact outcome we were trying to avoid. People buy when things feel safe. They sell when things feel uncertain. which often means buying high and selling low without realizing it, not because they are careless, because they are human. The market is one of the few environments where emotional comfort and good decision-making often move in opposite directions. When headlines are optimistic, prices are often already high when headlines are fearful. Opportunities may quietly exist, but fear makes them hard to recognize, and this creates a strange psychological tension. We want certainty before we act, but markets rarely offer certainty, only probabilities, and probabilities require patience. Patience requires emotional stability, and emotional stability takes time to build. Another reason many people feel unprepared is because investing forces you to confront comparison. You might be comfortable with slow progress until you hear about someone doubling their money quickly. Suddenly, your steady approach feels insufficient, even if it's rational, even if it's sustainable, even if it aligns with your real goals. Comparison changes the emotional equation because now it's not just about your progress, it's about your progress relative to someone else, and the internet amplifies this constantly. We see highlights, not context. We see results, not risks. We see outcomes, not sleepless nights. It creates the illusion that confidence is common, when in reality, most investors feel uncertain more often than they admit. Even experienced investors feel doubt. They just learn how to coexist with it. Which brings us to another quiet truth. Confidence in investing rarely comes before action. It usually comes after experiencing volatility and realizing you can handle it. It develops slowly, through exposure, through mistakes, through time, not through perfect timing. The turning point for many people happens when they stop trying to feel completely ready and instead focus on becoming gradually comfortable, because readiness is not a moment. It's a process. You don't suddenly wake up one day feeling completely immune to fear. You simply become less reactive over time. You begin to see fluctuations as normal, not alarming. You begin to understand that uncertainty is not a signal to panic, but a condition of participation. The market does not require perfection. It requires consistency, and consistency is easier when expectations are realistic. One helpful shift is this. Instead of asking, "Is now the perfect time to invest?" a more useful question becomes, "Am I building the habits that allow me to stay invested?" Because the real risk is not market volatility. The real risk is emotional decision-making during volatility. If someone invests aggressively but cannot tolerate uncertainty, they may abandon their strategy at the worst possible time, not because the strategy failed, because the emotional experience felt overwhelming, and that is rarely discussed. We often treat investing like a math problem, but it behaves more like a behavior problem. The numbers matter, but the decisions matter more. So what does becoming ready actually look like? It often begins with stability outside the market, having some financial breathing room, knowing that short-term expenses are covered. Feeling less dependent on immediate investment performance because pressure changes. Decision-making when every fluctuation feels high stakes. Patience becomes difficult, but when investing is part of a broader system of stability, emotional reactions soften. Another part of readiness is starting smaller than your ambition suggests. There is something powerful about learning how you personally respond to uncertainty, with manageable stakes, because everyone thinks they will stay calm until they see real fluctuations. Small beginnings create emotional war or data. You observe yourself, you notice your reactions, you learn where discomfort appears, and gradually, uncertainty becomes familiar. Familiarity reduces fear. Over time, you may realize the market feels less dramatic than it once did. Not because volatility disappeared, because your interpretation changed. You also begin to understand that progress in investing rarely feels exciting most of the time. It often feels uneventful, quiet, slow, almost boring. And strangely, that is often a healthy sign. Because sustainable financial growth usually does not feel like constant adrenaline. It feels like consistency, repeated long enough to become invisible. Another useful perspective. Your first investment does not need to be perfect. It simply needs to begin the learning process. Perfection creates delay. Delay often creates regret. Regret creates urgency. Urgency creates rushed decisions. And rushed decisions often increase stress. Slow decisions, thoughtful decisions, imperfect but consistent decisions tend to create calmer outcomes. If you feel like you're not ready for the market, you're probably more self-aware than you think. Because readiness is not about eliminating fear, it's about understanding it, working with it, designing systems that reduce the chance of emotional reactions becoming permanent decisions. The truth is, most people never feel completely ready. They simply reach a point where waiting feels less useful than learning. And they begin. Carefully, not perfectly, not confidently, just intentionally. Over time, uncertainty becomes less intimidating. Fluctuations feel less personal. Progress becomes less dramatic, but more reliable, and something subtle changes. Money becomes less about urgency, and more about patience, less about prediction, and more about participation. You don't need to rush into the market. You don't need to force confidence. You don't need to know everything before you begin learning something, because financial progress is rarely built on perfect decisions. It's built on decisions you can emotionally sustain, quietly, gradually, without pressure to prove anything to anyone, just a steady willingness to improve your relationship with uncertainty. And in a world that constantly encourages urgency, choosing calm progress might be one of the most powerful financial decisions you can make.